Hello everyone! Today's webinar will cover 5 steps to turn your nest egg into a retirement paycheck with Dana Anspach and CJ Miller. Dana is the founder and CEO of Sensible Money, and she is recognized as one of the nation's leading authorities on retirement and decumulation planning. She's the author of Control Your Retirement Destiny, a popular how-to guide, which you can also find as a podcast on Apple, Spotify, and iTunes. Her acclaimed online course, How to Plan for the Perfect Retirement, is available at thegreatcourses.com and at wondrium.com. Sensible Money was ranked 35 out of 500 in USA Today's Best Financial Advisory Firms in 2024 and was also named a Best Place to Work for Financial Advisors by Investment News. And for 3 years in a row, Sensible Money has been cited by Inc. 5000 as one of the country's fastest growing private companies. Joining Dana today is CJ Miller, a financial planner and a partner here at Sensible Money. CJ began his planning career at Sensible Money's first intern back in 2016. He's responsible for managing new and existing client relationships, and he oversees the firm's investment committee. I'm Nancy Fellinger. I'm one of the financial planners here at Sensible Money, and I'm in Pawleys Island, South Carolina. While most of the team is based in Scottsdale, Arizona, we also have team members working out of Massachusetts, Oregon, Indiana, Florida, and South Dakota. We are able to work seamlessly with each other and with clients all across the country every day using the same technology we're using today. You'll see a question box on your GoToMeeting screen, and we encourage you to add any questions to it as we go. There'll be plenty of time at the end to answer all of them. And I may respond to some of you directly or follow up with an email. The webinar is being recorded, and we will follow up with you with a link to it within the next several days. And so with that, Dana and CJ, let's get started.
Thank you so much, Nancy, and thank you everyone for joining us. I see a lot of familiar names in the list and a lot of new ones too, so we appreciate you taking your time. As usual, we are going to start with the necessary disclosures. We'll be using a lot of examples today, and we may be talking about some real-life client stories. We'll always change any underlying details so that you don't know exactly who they are, but all the examples we use are really things we've encountered. But of course, your experience is going to be unique to you. Investment markets change, as we'll illustrate. The particular time in history that you retire can have a big impact on your outcomes. So, of course, nothing is guaranteed. So let's talk about what we're going to cover today. There's 5 key steps that we think of when we talk about how you turn your nest egg into a series of reliable cash flows that you can expect will last for life. One is your money mindset. How do you think about money? What are the underlying emotions that impact your decisions? 2 is simply learning from the past. The more educated you are, the better decisions that you'll make, the more you can stick with logic versus emotion, and that's always a good thing when it comes to money decisions. Then we're going to talk about some specific strategies, what we call divide for success. So a particular strategy around how you set up your growth portfolio and what you call your paycheck replacement portfolio. Then when we talk about invest smartly, we'll do a little deeper dive on what do you put in that growth portion of your portfolio and what do you put in the paycheck replacement? How do you actually construct it and how do you actually get there? And then the last thing we'll touch on is the concept of setting up seamless paychecks. So we think it's really important to make that transition into retirement feel smooth, where you get direct deposits just like you do when you're working. We'll talk about why we think that's so important. Starting with your money mindset. I want to tell a story. So this is a client I worked with who is an executive for a Fortune 500 company. And he had a lot of company stock, as many do. I don't remember the exact number of shares. It might have been 30,000, 50,000 shares. We set up a set of covered calls on the stock because it was important to exit out of the stock in a reasonable way, gradually over time. And by setting up covered calls, it's a strategy where you can set the price at which you're willing to exit. but there's a risk. You might set up this strategy and the stock takes off upward and you sold some of the shares and the stock went higher. Well, everything was working according to strategy and some of the shares sold. And this person was really upset. And I remember clearly because I was at home, I was standing in my backyard. It was a beautiful sunny day. I had my feet in the grass and this person was irate actually. And it didn't make any sense. And I realized what was coming out was just a strong emotion. And as I just stayed calm and let them talk, they shared that they had grown up really poor. And somehow all of that came out when the stock sold, and it was only a couple thousand shares relative to the like literally tens of thousands that they owned. But the stock sold and it was a great price in hindsight, right? It was like, oh, we would wish all the shares sold at that price in hindsight. But after it sold, it went up a little more. And somehow that just triggered this irrational response. And it's just, when it comes to money, sometimes we're not always rational. That's the case. We've always encountered that. And that's why it's so important to step back and think about your money mindset. Particularly, this is one of our favorite books, The Psychology of Money by Morgan Housel. And he talks about how behavior is one of the keys to the success of money decisions. And it's really hard to teach behavior even to really smart people. People tend to chase returns. I remember a client, this was probably 2006, and there was a private lending product that my business partner at the time and I were looking into. And we thought it was a good idea for a small piece of someone's portfolio, no more than 10%. But this client was really nervous about the stock market, which in hindsight, he was right to be nervous about the stock market. We went through the Great Recession. But he pulled all his money out and put it in this private lending product, 100%. Well, the stock market went down and it recovered. But this private lending product went bankrupt, and they may have recovered a portion of their money. I don't know, because they put all their money in this product, so we weren't working with them anymore. But it was this kind of fear that caused irrational decisions. Greed can cause the same. CJ, I think you have a story of a kind of a maybe irrational situation that we encountered.
Yeah, that's absolutely right, Dana. And the reality is we see every single day retirees or pre-retirees that are entering that phase of life with an accumulation mindset. And it causes them to behave in a way that can be detrimental to their retirement when they need to be thinking about things from a decumulation mindset. Sometimes that's just wanting to hold on to a concentrated stock position that's done really well over the last 10 years. And other times, Dana mentioned chasing returns. And, I had a particular client, and she came to us and said, well, CJ, my sister is a very savvy investor, and there's this really limited investment opportunity that, she's getting involved with, and she's had a lot of success in these kinds of ventures in the past. And, she's done her due diligence, and I'd like to join her. And, she ended up making a 6-figure investment in a private investment. And it turned out it was a fraudulent scheme. It was a Ponzi scheme. And, this wasn't, a decade ago. This was as recently as last year. And so these things do happen every single day. And I think about that a lot, not just because the client experienced a negative outcome, but also because when you look at their plan in general, she's still doing fine. Her plan's still, looking great. But even if she had the best outcome from that investment, would it really have changed her life? Would she be spending more in retirement? Would she be more comfortable? Would it help her achieve her goals? And the answer is not really. And so you really have to step back and ask yourself, well, what are you trying to achieve? And, why make a decision like that without really understanding the full risks involved? And the reality is, even though most people don't think that those circumstances will happen to them, we all have cognitive biases that we need to address as we enter retirement or any kind of, big decisions.
Yeah, and CJ, you touched on two things. One, that shift from the accumulation mindset to the decumulation mindset that I think is so important. And the second thing I know we'll talk about is you touched on biases, and we'll talk a little bit more about those. But diving a little deeper on this mindset shift, we talk a lot with our clients and in our work. We've done a lot of work about just looking at when you're in the accumulation mode, there's a certain way of approaching portfolio construction where you maximize returns for a given level of risk. And that makes sense. But when you need to now live off your acorns, as we describe it, you need reliable cash flow for life, and you are actually solving for a different math problem. So the portfolio that may be more likely to deliver reliable cash flows isn't necessarily the same portfolio that will maximize returns when you're in the accumulation. And on this slide, I quote a paper for those who want to deep dive into this. It's called Chaos and Retirement Income by Jim Sandage. But he's done a lot of work on this and really looked at in retirement, avoiding the strong years of negative returns, avoiding having to liquidate assets during those negative returns. That can have a lot more impact on your outcome than constantly beating some kind of benchmark like the S&P or even achieving the S&P. So it definitely requires a shift in mindset. CJ, anything you would add to that?
No, other than just in general, I think you have to be open-minded that your risk parameters have changed. And that's exceptionally hard to do. Like Dana said, we're going to talk about biases. I think the next slide is recency bias. But after you've had a few good years in the market, like we've experienced recently, your perception of the risks you're taking can change. Even before 2022 or 2021, we would mention inflation risk to clients. And I'd see their eyes glaze over because really for a lot of people it's theoretical, right? And they'd say, well, the last big inflationary risk we had in this country was the 1970s. Maybe some of them were kids or not even born yet. And the reality though is, well, inflation came back. And so these risks that we talk about, they're very real. And as you enter this phase, you have to take them seriously. And that can be hard to do if they haven't been readily, on your mind or even something you've ever even experienced.
Yep. It's a great point in terms of, and we will get to the slide you mentioned on recency bias that ties into. And so I want to come back to something you just said about inflation. But expanding just for a second on the different math problem, when you look at retirement, what you're looking at here are the factors that you have to balance. So on the vertical axis, we have wealth transfer value. How much are you going to leave to heirs? Across the horizontal axis, we have sustainable income. So how much cash flow can you reasonably expect to withdraw each year? And then on the right-hand side, you see shortfall risk. So what's the risk that you live longer than your projection, or you have some household, what we call expense shocks that require extra money coming out of the portfolio? Often that can have to do with either a health event or some situations with adult children, or where we see that show up most frequently. And so the more you take out of the portfolio, the bigger your risk that you could come up short later. And so it's a constant balancing act. And back to like the portfolio that helps solve for this and the math that helps solve for this isn't the same type of math and portfolio that we use when we're 30 years old or 40 years old and trying to maximize the growth in our IRA and 401k. Now, CJ mentioned inflation and cognitive bias. So it's in the world of finance, there's a field called behavioral finance where they study a lot of different biases that impact our money decisions. There's one called anchoring as an example. And so in the case of the story I told with the client that sold the stock, sometimes you anchor in on a certain price that can happen. And I saw someone pop a question in that said, couldn't the client have just bought back those shares at the same price? Yes, but it was a taxable event. Once those shares were sold, that tax was incurred. There was a capital gains tax. And so, yes, you could buy back the shares if you wanted to still own them, but you couldn't avoid the tax impact that just happened. It was a taxable gain. But anyway, we anchor in sometimes on certain prices. I've seen that happen with people with tech stocks where the stock went down and they're just anchored in that they're not going to sell it till it gets back to this price. And in some cases, that's never happened. And so they've held on to a stock for a decade when it never got back to it. And then recency bias. CJ's example, your example, CJ, was perfect. Inflation, we went through a decade of no inflation, so recency bias makes us go, well, we don't have to worry about that. The other thing we're seeing lately is the outperformance of the S&P and particularly large cap growth. And that's another form of recency bias. CJ, share with us, what are we looking at here and how does that tie in with what we're talking about?
Absolutely. So what this chart is showing is not market performance. And so I want to make that clear. The orange line, what it's representing is the valuations of large cap growth stocks. So think the Nvidias of the world, the Teslas, much of the market capitalization in the U.S. market and the S&P 500 is concentrated in these large cap growth stocks. The blue line is small cap value stocks. The way to think about valuation as a concept is just what price are you paying for the expected return or earnings on a particular stock. This chart is using a ratio called price to book. A commonly quoted ratio is price to earnings, the PE ratio you might see as you look into this. And so what we're seeing is basically the historical valuations of each of these two asset classes from 1926 all the way to last year to 2024. And what you see is that small cap value companies have been pretty consistent. Now, that doesn't mean they haven't performed well. Ultimately what that means is that the price of the companies has moved in line with the earnings. So you could still experience a great return. You're just not necessarily paying a premium to get into that market. Whereas today, if you were to buy large cap growth, well, you're paying more per dollar of earnings than you would have paid in pretty much any time. 2020 was pretty close. And so when we talk about recency bias, it's not just what happened in the last 6 months. And, oh, a company had a big run up. Now I think that's going to continue. That's how most people think of it. The reality is market cycles last a really, really long time. And you see that, right? There's a very common thread here when you look at 2000 and what happened in 2001 and 2. Well, the tech bubble burst and you see those valuations drop. And so we don't have a crystal ball here. We don't know if large cap growth companies are going to continue experiencing the returns that they have been lately over the next few years. But ultimately, we do know that historically, even though past performance isn't a guarantee of future performance, markets typically revert back to the mean. And so for most clients that come to us with their portfolios and are looking to transition into retirement, the vast majority of them, whether they're buying index funds or actively managed funds or individual stocks, will have about 70% of their portfolio in US large cap companies, mostly tilted towards growth and towards tech companies. And when we explain, well, you should probably reduce that allocation and diversify, a lot of the time we get pushback. And this is the reason why, right, that we look at making those kinds of moves, because we don't know what the next 10 years are going to hold. We don't know when the next 2000 to 2002, where you see those valuations come back down to earth, is going to happen. But we do think at some point it will. And you don't want your retirement to depend on it not happening because you didn't diversify.
Yeah, and I think that goes back to, when we're talking about avoiding the big negative returns. And that is so key. Once you're drawing money out, you are regularly selling investments. And it's a challenge we find. So, just this week, I've encountered it actually twice where, clients have a plan and we have to liquidate certain investments to cover their cash flow for retirement. But when we actually get there, they're like, oh, but I don't want to sell that. And so we're like, we have to sell something. The cash has to come from somewhere. And so what we want to use is a very disciplined process about what to sell and when to sell it. And what we don't want to have happen is that someone hangs on to something, experiences this big downturn, and now you're forced to sell in the middle of one of those down markets. That's what can have a more detrimental impact that will last throughout your retirement in terms of the amount of cash flow and wealth you have. Now, another bias that we encounter is overconfidence, and that applies to all of us. There's a famous study that was done many, many years ago where they sent out a survey and asked people, how many of you would categorize yourself as an above average driver? And something like 90% of the people said, yes, I'm an above average driver, which of course that can't be. Whatever that is, only half of us can be above average. And so it was the beginning of this study around overconfidence. We're often overconfident in our abilities. And Michael Kitces is one of the authors of this paper. We've got it sourced here at the bottom on old age and the decline in investment performance. And it really is charting out here. You've got age across the horizontal axis. The orange bar is financial literacy. And the blue line, not bar, blue line is the financial confidence. And so you look out here in someone's mid 70s, that's the phase where we often describe you go through these phases in retirement, the go-go years, the slow-go years, and the no-go years. Well, during those, what usually become the slow-go years, the confidence in one's ability often goes up, but the actual scores on the financial literacy questions go down. And so this is scary. We can hit that point in our life where we're feeling more confident than ever that we know what we're doing. And yet in reality, we may not be thinking as clearly. Now, I know we see not confidence, we see cognitive decline come in with our clients. CJ, you and I have a client. I've worked with them since, I think they're the firm's oldest client since 2002, and now you work with them. Share us a little bit, what happened as cognitive decline set in? What did they do?
Yeah, that is a really great story, and it's actually a success story. And so it's never fun to think about cognitive decline, but we were so proud of this client for the proactive steps that they took. And so I want to share it because it could be an example for those of you, whether you're dealing with aging parents or you start to experience this throughout your own retirement. Well, this client went to the doctor, and he was 78 at the time, and he came to us, and the very first thing he said is, "Well, I've been diagnosed with Alzheimer's." And, I haven't experienced many of the side effects yet, but I want you to make sure anytime I'm in a conversation with you that my spouse is on the phone. And so that was the very first step, is always have somebody else, there. And then he asked, if I start asking for things multiple times, let me know, because I want to manage the symptoms moving forward. And the biggest decision that he had made that I was most proud of personally was, he said, "Well, you haven't met my adult children. And I really want to involve them moving forward in the meetings because I don't know how this thing will progress." And so those 3 steps alone, really set the stage for protection against, asking for money multiple times or, falling for elder abuse scams. And so I really, appreciate the way that client approached that situation, but many don't. And that can lead to a negative outcome, or sometimes we just start to see uncharacteristic requests from our clients as they age, and it kind of has us taking a step back and pause, and sometimes we have to have difficult conversations when that starts to happen.
Yep. In most cases, we find if people have established a relationship early in their retirement process, then when they get to this phase, they have confidence in what we're doing, and there's just a lot less stress. So they're able to not make knee-jerk reactions around their finances because they know we've got a handle on it. And there's just that layer of protection that comes in there that we think is super valuable as people are in these mid-retirement years. Moving on to learning from the past. I think education is really what helps us make better decisions. Even if you're working with an advisor, you need to be informed enough to be able to distinguish the difference between good advice and bad advice. So reading books, attending webinars like these, all of these things can help you become educated enough to really recognize, what does good advice look like and what are some reasonable expectations. That often starts with a chart that looks something like this. CJ, walk us through this.
Yeah, so what we're looking at here is a foundational chart for what's called modern portfolio theory. And in a really simple sense, that means what I think is pretty obvious to most people. If you take more risk in the portfolio, meaning buying more risky assets like, say, stocks, you should expect a higher rate of return than if you have less risky assets like, say, bonds. And the risk manifests in volatility. And so you'll see the annualized return get higher the more you add those risky assets to that allocation, but the 1-year drawdowns also get greater. And so many people, whether in accumulation or decumulation, will manage their portfolio towards these risk parameters. And over long periods of time, it tends to show true, right? If you have a 100% stock portfolio, it's more volatile. But also, if you have a longer time horizon, you should experience a higher rate of return, and that's historically been what's happened in most cases. But in retirement, it doesn't show the whole story. because two things change. One is you no longer have necessarily 30 years for your money to grow uninterrupted, right? And two, you're taking withdrawals from the portfolio in most cases. And so the second you start taking money out of the portfolio, your need from the portfolio changes. And that can change the trajectory of these returns, whether you experience a good market or not. And the next slide really does illustrate that.
Yeah. And so, kind of going back for a second, if you were thinking of the traditional retirement portfolio, 60% stocks, 40% bonds, and you go, great, I should be able to expect a 9% rate of return. And, I'll plug that into my software to project my outcomes in retirement. Well, this chart, what we sometimes call the spaghetti chart, takes a real historical scenario and says, okay, we plugged in retirement assets. In this case, the person had between 3 and 4 million. And these dashed white lines are what's called their critical path, the minimum amount of assets that they need to have for their plan to work. Each yellow line represents an actual historical path. So if they had retired in 1927, if they had retired in 1928 and withdrew what was supposed to come out of the portfolio, well, we don't see a nice linear 9% rate of return. We see sometimes the assets grew immediately off the chart. There's other times where the portfolio would have dropped to half its value with 5 years of retirement. In most of those cases, it recovered and they were still okay. But in some cases, the portfolio ran out of money. This was one case in the Great Depression. In some cases, it spent itself down, but not enough to run out. So we see lines that end up over here. And so the actual variance in outcomes we can experience is far greater than what a linear projection, something like this, might lead us to expect. Like in our mind, we're expecting it to be linear and nice and neat. And then reality is, well, we only get one of these yellow lines. Like that's it. We get one shot at retirement. And we have to be prepared for if this happens, are we ready? And how do we stick with our portfolio? And how do we have a plan to weather through it? Anything you would add to that, CJ?
Nothing specific other than this is my favorite chart that we show to clients. And when we talk about a mindset shift, and you may ask, well, how do I do that? Conceptualizing your plan in this way is a lot more successful than say trying to benchmark your performance against like the S&P 500 or reading the Wall Street Journal every day or watching CNBC. This defines outcomes. And so, we'll talk later how we actually structure portfolios to deliver outcomes. But if you're really struggling to make that mindset shift, start with this kind of thinking. What does my trajectory look like? And what are the risks and the possible paths that I might go down, knowing that we have all of this uncertainty that we're entering into.
I love that word outcomes. We use that a lot because retirement really is about outcomes. There's a book I had read years ago called The Number by, I believe the author's Lee Eisenberg, and it was all around retirees fixated on a particular wealth number. And you can retire with very different wealth numbers and yet have the same cash flows over your lifetime. And we'll look at an example of that in a minute. But it's truly about the outcome of, can I maintain my lifestyle? And that's about cash flow. Another example we use with clients when we're talking about the difference between accumulation and decumulation is this graph. So this is charting the S&P 500 from 2000 to the end of 2014. So it's a 15-year time horizon. And while we've seen the double-digit returns in the last 2 years, it hasn't always been that way. So over this 15 years, the S&P had an average annualized return of 4.25%. And if you were saving for retirement, you're an accumulator. For every 100,000 you had, this dashed line shows you what would have happened. And most of the growth came, of course, right after the Great Recession. And so your 100,000 would have almost doubled. But if you retired in 2000 and you are withdrawing $5,000 a year, well, the investment still had a 4.25% rate of return. That's what you're seeing over that time, but you're drawing money out. And so your principal got spent down, from about 100,000 to about 40,000 over that time frame, and your internal rate of return was 0.7%. Now the investment did the same. So it's hard to understand sometimes, as we said, how that math changes when you're drawing money out. Now, what's interesting is if these returns had happened in the exact opposite order, so all these good returns that we saw after the Great Recession, right? Those had occurred first, and then the downturn in the tail end of this 15 years. Well, the investment would have had an internal rate of return of 5.1%. And I think that's right. Actually, I only have the internal rate of return on my retiree in that case, which would have had a 5.1% internal rate of return. Looking at my notes over here. So I'm not sure about the actual investment. It should have been almost the same. And so the outcomes when you're looking at retirement can be different than what we think based on what we're seeing in the media, right? Here, over this 15 years, you're thinking, oh, my retirement portfolio should be going up, but you're drawing money out, and that changes the way that it actually works. CJ, any clarifications on that?
No, I think it was explained very well.
Thank you. Moving on to our philosophy around divide for success. So I talk about this triangle in terms of as you move toward one corner of the triangle, you move away from the other two. So if you want something that's safe, it's not going to grow as much. It's not going to provide as much income or cash flow. If you want something focused on growth, well, it's going to be not as safe and not as much cash flow. If you want something that provides maximum income, there's always these trade-offs. And so in a portfolio mix, you're always balancing out, okay, how much of what do I need in which account to find the right mix to accomplish my goals? When we think of retirement, we like to look at it in terms of two broad buckets. The growth bucket, which provides fuel over time to keep up with inflation and to grow enough to provide your cash flows during your later retirement years. And then the paycheck replacement portion. And we think of this in terms of the number of years of cash flow that are covered. So we're, as financial advisors, often trained to think in terms of traditional allocations, 60% stocks, 40% bonds, 70% stocks, 30% bonds. Instead, we think in terms of, well, how many years of cash flow are covered by safe investments, money market, maturing CDs, agency bonds. We'll talk about some of the specifics in a bit. But how long could I live off these maturing bonds if I were in the midst of a big market downturn without having to liquidate anything that's down? And so think of this in terms of there will be years where this orange juice glass is truly overflowing, years where the growth portfolio does well, and you are pouring some of this juice over here to fill up the paycheck replacement bucket. And there will be years where it doesn't grow enough to get over the rim. And in those years, you don't want to be dipping into it. And so it's not the traditional rebalancing process. It's something that's a little more, I'll think of it as process-based. And so you can't just program it into a computer. Well, eventually you probably will be able to, but it's not just, January 1st or March 31st, I'm going to hit the rebalance button. It's instead measuring against your path. How far ahead of your goals are you? And how do you make a process that tells you when should I move money out of this growth bucket and put it over here, and when should I leave it alone? And I wrote a paper on this process that was published in November and December. The link is at the bottom of this slide. We've also uploaded it as a handout. It might be in a section in your bar called Materials, where you could download the PDF, but you can also find it online at this link. And it's called The Wind Down, Managing Risk in the Retirement Red Zone. And in this paper, I compare 3 different strategies. What we're looking at here are graphs of the end of year equity allocation of this household. And so I compared two different retirees, one who retired in 2002, and we start looking at their portfolio 10 years before retirement, so in 1991. The second retiree retires a decade later, 2012, and we start looking at their portfolio again 10 years before retirement in 2001. So in both cases, we compare three strategies. One strategy, the top line called aggressive, says, well, I'm going to stay 100% equity until the cusp of retirement, basically the day I retire or that year. And at that point, I'm going to sell enough of my equity portfolio to build out a number of years of cash flow so that I have my cash flow covered by bonds. So if the market goes down, I don't have to rely on my equity bucket. The second line, the mid-colored gray, is the wind down strategy, which most closely reflects what we do. There's a process that says, when do we sell growth and add on to that cash flow bucket, and when do we leave it alone? And it's often dictated, well, it is dictated by how well does that growth bucket do. If the growth bucket grows enough to allow me to sell, for example, a full year's worth of cash flow, I'm ahead of my critical path, then great, I'm going to sell and I'm going to fill up my paycheck replacement bucket. And then the darker line reflects a strategy written about by one of our industry favorite researchers, Michael Kitces, where he talks about something called the bond tent, where to really protect yourself from a downturn, you aggressively sell growth investments. And so your equity allocation went from 100% to 40% in the decade leading up to retirement. And then you spend out of that paycheck replacement bucket. And as you're spending those bonds down, your equity allocation is rising, assuming that the equities go up. And so here we're just looking at the allocation, right? This isn't about the performance. This isn't showing you how the strategies did. It's just simply saying, let's look at what the allocation would look like across these two different time periods. One, someone retiring 2002, one retiring in 2012. Now, when I go into the details in the paper, I use examples like this. I don't use this particular slide in the paper or figure because it's complicated. And the editors said, oh, this is just too complicated to put in this paper. It'll confuse people. But in reality, this is how we think about it and how we're actually implementing the strategy. So in order to do all of the graphs, you have to have the math behind it. And so here we're seeing someone, they started with $1 million in 1992. End of 91, think of it. And during the year, the stocks went up 7.6%. So think of that as 76,000. They were also funding their 401k, 25,000 a year. And so that gave us $100,000 of equities to sell. And we added that to their fixed income bucket. And they are 10 years out from retirement. They now have a bond that's going to mature out here when they retire in 2002 for $100,000. So we're assuming this person needs $100,000 a year, and they're going to need that $100,000 a year to go up with inflation. So year two, they're going to need $103,000. Year three in retirement, they're going to need $106,000. The next year, 93, stock market went up 10%. We're able to sell $103,000 of stocks and build out their second rung on their paycheck replacement portfolio. Well, because the stock market did really well, this process continued. And by the time they got to 1999, they had 9 years on their paycheck replacement bucket. And then, of course, we had 2000, 2001, 2002. Now, not only did they have 9 years in their income bucket, but those bonds earned interest, and that interest allowed them to buy a 10th year in their income ladder. So right before retirement, they experienced these 3 years of negative returns, but they were ready. It didn't have to derail their retirement. They were able to go into retirement and start spending these bonds as they matured. And as you're spending those bonds, If the stock market does well enough, here we've got 2003 where it finally had a good year, we're able to sell more stocks, and we've spent down our bond ladder now by a year, but we're able to replenish it, and it essentially was able to maintain itself out here by 2011. We're down to about 6-year ladder left. They were able to build up that kind of bond tent, a really strong runway into retirement by using this process-based approach. What about somebody trying the same approach a decade later? This person is planning to retire in 2012. It's the year 2002. Well, as we saw, the stock market was down that year, so they maintained their 100% equity portfolio. But for the next 5 years, they were able to sell stocks and buy bonds. But then we had the Great Recession, and their portfolio never got back up over, in this case, we wanted at least 60% equities before we made that shift and added on to their paycheck replacement bucket. And so they maintained that 5-year bond ladder, and we got out here, they retired. We had a few good years, and so even though they were spending out of their bond ladder, they were maintaining it. And by using the same process, here they were in 2021, still with a 4-year ladder. Both retirees had the same cash flow. So when we look at this cash flow, our 2002 retiree got there with $3.3 million by the time they retired. Their growth bucket was $2.2 million. And here was their paycheck replacement portfolio, and they had this 10-year ladder. Our 2012 retiree, they got to retirement with $1.6 million. Their growth bucket had just over $1 million, and they had a 5-year ladder. Now that ladder, as we saw, continued to build out for the decade. So both retirees had the exact same cash flow. And it's likely both retirees are going to have the same cash flow for the rest of their life. They're just going to leave a different amount of wealth to their heirs, or this retiree had a better market outcome, a better time in history that they retired into, so they may up their spending because they're able to. When you look at this in a comparison approach, this is their wealth outcomes. Remember, they have the same cash flow. So in terms of cash flow, the outcome was the same. But the aggressive portfolio, if you maintained 100% stocks until the cusp of retirement, well, it accumulated the most wealth, but this would have been super scary for that 2002 retiree going through this kind of downturn. The bond tent offered the most protection in terms of low volatility. And the wind down approach did just slightly better than that bond tent. Then we look at 2012. We have the same 3 strategies. Our aggressive approach, amazingly enough, it wasn't the top winner at that time period. It was the wind down approach that accumulated the most wealth. And then our bond tent approach was almost in line with the aggressive one, just a little bit worse. And so the terms of your total wealth that you're accumulating, right, that's going to vary a lot dependent on market outcomes. But when you're planning for retirement, if you're using this cash flow based approach, you're planning for cash flow, it doesn't have to impact your retirement lifestyle. If you plan correctly, both of these people, depending on our 2012 or our 2002 person, are going to be able to have the same cash flows. That was a ton of technical stuff. CJ, anything you want to add on or explain that maybe a little better way, more simply than I was able to?
Well, I think there's a key takeaway, regardless of the strategies or the analysis from this. And what I took away from it, watching you review it and having read the paper, is how important it is to start early. And there's pros and cons to every strategy. You've got to be able to evaluate those risks and those potential outcomes because you don't know what you're going to retire into. But what we see as a constant is that people that decide to plan for retirement early tend to have a better outcome, no matter what risk preferences they want to weight towards. And so if you're within 10 years and you haven't really thought about how to transition your portfolio, it's certainly not too early. Occasionally we'll have introductory meetings with clients and they'll say, hey, I don't know if I'm close enough to retirement to work with you. And the answer is almost always, it's better to start sooner. Occasionally we have clients that say, oh, I retired last week, so I engaged with you. And I kind of go, well, we can help you, but I wish you would have started sooner. And so that was my biggest takeaway from the study.
Yeah, CJ and I had a client we worked with jointly a few years ago. They came to us right on the cusp of retirement, and they actually did have a 100% equity portfolio. I use the 100% equity as a starting place in the paper because it makes for a nice, simple way to illustrate the transition. In reality, most people don't come to us with 100% equity. My personal plan would be to stay 100% equity until 10 years from my retirement. And CJ and I had this client that was doing that exactly, but they waited till right before they retired. And I was so nervous. I hate it when I'm more nervous than the client. I was thinking, oh my gosh, as we transitioned this portfolio over, we were able to build out their bond ladder. And then we went into, I can't remember what year it was, 2018, or it might have been 2022, where the market did go down quite a bit. And so they and we were very grateful that we were at least able to get that paycheck replacement portfolio in place. It makes me nervous when people stay 100% equity until the cusp of retirement. So but that is a strategy that it's in a few papers that have come out recently that people are talking about as a way to maximize wealth. The challenge I have with it is back to the behavioral side. As humans, we're not always logical, and that goal to maximize wealth by staying 100% equity is fine as long as things are going up. But how do we react in the midst of a big downturn, right? Are we going to be able to leave it alone, give it time to recover? Are we going to panic and sell out? And so it just makes me really nervous from a behavioral side. So like CJ said, I think people are best off starting early. One of my favorite clients that came to us actually came to us 10 years before retirement. We've built out 2 rungs on her income ladder now. It's the only time I think in my career I've been able to actually do it exactly like I think it should be done. It makes me so excited. I wish everyone would do it. Then it comes down to monitoring the process. So we talked about monitoring, and I talked in the paper about monitoring against your path. So how much do you need? Are you measuring against this minimum amount that you need? And in this case, this is the client that we started tracking their path at the end of 2014. And the yellow line, as we said, they get 1 yellow line. And this is where they're at. They're ahead of path. And over the years, they retired. I use this example in some of the presentations I do at industry conferences. So they retired with about a 7-year bond ladder. And today, they still have a 7-year bond ladder. And so we were able to use the bonds during these years where their portfolio was down. And then during these years where they were ahead of path, we were selling growth and refilling the paycheck replacement bucket. During this March of 2020 that we all wish we could forget, we were not selling any growth. And then since then, the market has recovered. And so again, we've been able to sell growth and simply maintain their income ladder so they're insulated against these times where the market goes down. CJ, I know you do a lot of extending bond ladders with clients who are in this phase. Anything you want to add to that?
The one thing I would add is that by using a bond laddered approach, there's a psychological benefit to it. And when you experience those years where the yellow line dips into that pink area or even to the red, it doesn't necessarily mean you have to cut spending. People tend to think that, oh, I need to tighten my belt in a recession. The whole point of bifurcating the portfolio and really dedicating your assets to the job in that triangle, safety, income, or growth, is so that your first instinct doesn't need to be, oh, I need to adjust course when there's a systemic downturn. We know there's going to be bear markets. We don't know when, but we do know that they will happen throughout your retirement. It's perfectly normal as part of the economic and the equity market cycle. And so this approach, typically we'll see not only is it effective on, within just practice, but also psychologically for our clients, it allows them to sleep at night when they see those extenuating circumstances in the market and feel comfortable spending the assets that they've worked so hard to build.
Yeah, and I love what you said about like we know that bear markets are going to come, right? And so we just don't know when. And so having a plan to weather them is key. I know I had seen a comment come in around, well, should I be selling all my, I can't remember because the question, so many questions have come in, which we love all the comments and questions. Thank you. That it scrolled out of line of sight, but it was something around, should I be selling all my after-tax assets or pre-tax assets? And no, like we don't necessarily advise that. We advise having a systematic plan. What you actually do, how you implement that plan is going to depend on all kinds of factors. How far away from retirement are you? How much cash flow do you need? And what account does it need to come out of? Like all of those things have to be laid out before you go changing around the portfolio and potentially incurring tax consequences. So, you know, we could see, as CJ said, many more years of great stock market returns. We don't know. In the late 90s, the market stayed overvalued for many years. So we don't know if a bear market is imminent. We just know we will encounter one, and you will encounter probably several over your retirement years. So just having a process says, I don't have to panic. And when this happens, I don't have to panic if this happens right before my retirement because I've laid out this plan and this process. All I have to do is follow it. I've seen some questions come in specifically about bonds, individual bonds, which is better. And so we're going to talk about that. I don't know how much detail we'll get into, but when we think of investing smartly, definitely we want to use a rules-based approach. Making decisions based on emotions or hot stock tips or CNBC, it's not the way to go when it comes to your retirement money. When CJ was talking about the mean reversion chart, this slide came to my mind. CJ, what are we talking about here?
So really what we're looking at, it's a pretty simple slide. There's two circles. One is the S&P 500. That's 500 stocks. The other bigger circle is a globally diversified portfolio, which can expose you to over 12,000 different companies worldwide. And so global diversification is kind of unpopular right now, believe it or not. And the reason is because that S&P 500 bubble has outperformed for many, many, many years. And international companies, the other 11,500 companies in that big bubble, haven't done as well by comparison. As Dana showed with the 2002 and the 2012 retiree, not all market cycles are the same. And so, ultimately, when we look at a globally diversified equity portfolio, there's a few ways to think about diversification. Many people think, as long as I have an index fund or a mutual fund, even finance professors, I learned this in college, will tell you all you need is 30 stocks to be well diversified. That's only telling part of the story because asset classes tend to move in tandem as well. And so if all you have is large cap growth and you're tracking your success against the S&P 500, that may have benefited you over the last few years, it could really harm you in the next, say, lost decade, if there's ever one that manifests that way again. And that's really the importance. So the way we view investing smartly for the equities is making sure that you're capturing global GDP. There are times where certain countries fall out of favor. And I know we like to go back to even the 1800s sometimes with stock data and pretend like it's a law of physics. It's really not that tenured when you think about other sciences, right? Like how long has physics been around and gravity? Well, forever. And so we are really working on, a little over 150 to 200 years of data. You could go back and learn about Rome's economy and see how that fell. Even as recently as the 1990s. If you entered the 1990 stock market, you'd hear a lot of voices telling you to buy Japanese stocks because they just exploded throughout the late 70s and the 1980s to the degree where they became so overvalued that they still haven't gained very much. And Japan's an advanced economy. They're thriving. They're making things. Their people are employed. They have some significant issues within their economy. And it was deflationary for a long time because of that run up, but it can happen. We're not saying it will. We still invest in the US, more so than international. But as I mentioned before, most clients come to us with about a 70% portfolio, all in US large cap, maybe 5 or 10% in US small cap, maybe 10% of developed international, and almost no emerging markets. And the research shows for a long-term time horizon, especially for a retirement portfolio designed to minimize volatility across market cycles, it's not going to be the best approach.
I love that. And what comes to my mind is an analogy I've used around motorcycle riding. For those of you who have followed me for a long time, you know that I spent years riding motorcycles. I still have my Harley Softail Slim. Sadly, I'm getting ready to sell it. I now play pickleball. This aging thing, it involves some changes like this. And so I loved my motorcycle riding years, but I tried to diversify the risk. It's inherently dangerous, more dangerous than driving in a car. And yet you can diversify away as much risk as possible by wearing a helmet and the right equipment, by riding in daylight, by not drinking when you ride, and by riding in large groups. And so all of those things can be diversified away. And so when we think about the risk of owning a single stock, that might be like riding a motorcycle by yourself, no equipment. You're riding at night after a few drinks, right? There's inherently a lot of risk in that. Now, maybe you get lucky and you make it home and you don't get hurt, no one else gets hurt. But when you start to diversify from a concentrated position to something that is very broadly diversified, you have diversified away all of the risks that you can diversify. On that equity bucket, there's even a way to dive a little deeper and look at different equity factors. CJ, walk us through this and how we apply this to our portfolios.
Yeah, so like Dana said, everything we do is research-based and it's rules-based. And what the research shows is that over time, small company stocks will outperform large company stocks, value stocks will outperform growth stocks, and high profitability stocks will outperform low profitability stocks. And so what this chart is showing is over 1 year periods, the percentage of time that's been true. So over every 1 year period, I can't see in the fine print where this goes back to, but probably since, potentially 1920 something.
26.
1926.
26 or 27 in these cases.
Yeah.
High profitability goes to 1963.
Yes, and that's for just reliable data effectively. But either way, what you see is over 1 year periods, it's true some of the time, but certainly not all of the time. There are many 1 year cases where these premiums don't manifest. But when you extend that time horizon to say 10-year rolling periods, well, you see it be much more apparent that can happen. But it still won't happen every 10-year period. There's not one 10-year mark chart that says 100% of the time, large cap will beat or small cap will beat large cap or vice versa. And that's why the diversification is important. I know I'm kind of picking on large cap growth stocks. Our portfolios still have them, right? We're not saying you shouldn't have them. We're just saying it shouldn't be 70 to 80% of your portfolio. And that's hard to conceptualize after a few years of really good performance in that sector. I do want to mention, I know we want to leave time for questions, so I'll do this very briefly. Profitability matters a lot. We get asked very often why we use dimensional funds as our primary ETF provider, as opposed to, say, an index company like Vanguard. And even though they're very similar in philosophy, they're not trying to pick the best stocks on a quarterly basis and have really concentrated positions within their funds. Dimensional funds does not track an index. And that allows them to screen for things like profitability. Whereas if you buy a Vanguard fund, even though it's lower cost, it's got a lower expense ratio, Vanguard's small cap fund is not screening for profitability. And when you look at certain asset classes like small company stock, low profitable small company stock are some of the worst performers historically of any sector in the market. And that makes sense, right? You're buying companies that are not as well known, they're not profitable, they typically might not last that long, so to speak. Whereas dimensional funds can screen for profitability and completely omit those low quality companies across asset classes. So I always like to point that out because profitability, it's not commonly known or tracked because there's not really a profitability index to look at. But it definitely matters, the types of equities you buy, even within a well-diversified portfolio.
Yeah, and what I like when I look at this is I talk about playing the odds in retirement. So when we talk about longevity, right, what are the odds that you will live to a certain age? When you look at living to your mid or even late 80s for white collar workers, the odds are pretty high. And so as you're looking about making decisions around Social Security, for example, those odds factor into the decision. Well, when it comes to our portfolio, these long-term odds are pretty compelling. So if I can invest in an asset class that 68% of the time is going to have better performance than another asset class, I want to do that. Or I at least want to make sure I have exposure to that in my portfolio. And as CJ was saying, we often see the opposite, where a portfolio will be concentrated in something that has done well recently, but when you look at the long term, it's not taking advantage of just the long term odds that we see. Then when it comes to the fixed income side, I saw a lot of questions come in about, bonds versus bond funds. In general, we're a fan of individual bonds for retirement cash flows. Bonds mature. We know what they're going to deliver and when they're going to deliver it. And so that lines up perfectly with cash flow needs in retirement. It's a process called asset liability matching. It's the same process that pension plans use. So big pension plans have to pay out paychecks to the retirees. And so for the cash flows they need to deliver in the next couple of years, they have very safe assets maturing so that they know that cash is available to pay out to their people receiving the monthly paychecks. And so that process can be applied to your portfolio. And we do like individual bonds. Sometimes there's packaged bond ETFs called bullet shares that work. What we're looking at here is when interest rates change, it will affect the price of the bond, whether it's a bond fund or an individual bond. But there's a difference, and we'll talk about that. But in general, if interest rates were going to change by 1%, well, if rates rise and you have a bond that's 5 years to maturity, it's going to go down. The price of the bond's going to go down by 4.4%. If you own long-term bonds, bond that's 20 years to maturity, the price is going to go down 12%. We saw this happen. It's why some of the banks went under, because they had a lot of long-term assets on their balance sheets and interest rates went up. Those bond prices went down. Suddenly the bank was undercapitalized. Now, when we're looking at this for retirement, if you own an individual bond and it matures, it's still going to go down on paper. But if I hold it to maturity, I'm going to get the original original principal value back, right? I'm not going to have to worry about this. But if I'm in a bond fund and a bunch of people liquidate the fund at that time, that fund is going to have to sell some of the bonds. And they're probably not going to get good pricing that can permanently impact ultimately the share price of the bond fund. So in general, we like individual bonds. I also saw a lot of questions come in around what type of bonds. CJ, you've done a lot of work lately on like treasuries versus agencies and tax efficiency. Talk a little bit about that.
Yeah. Well, like Dana mentioned, we err towards buying individual bonds versus bond funds, and that's to hedge against this interest rate risk. I love this chart because it's, I think, timely. Many people are confused when they see 2022 returns and they ask, well, why was that one of the worst years for the 60-40 portfolio? And I say this chart is why. Those bond funds just got hammered, especially the longer duration ones. And so in order to hedge against interest rate risk, where you can buy an individual security that you hold, you trade that for something called default risk, meaning in a bond fund, you have a collection of bonds. So if one issuer defaults, well, you still have a whole bunch left to basically preserve your assets. Well, if you're buying one bond for, say, $100,000, it's going to mature in January of next year, or to spend $100,000 of it, and that issuer defaults, right? That's a really negative outcome. And we don't want to take that risk at all. Just period, point blank. If we're going to take risk in portfolios, we're going to do it on the equity side of the portfolio, that growth area of the triangle. And that's why we don't buy corporate bonds on an individual basis. It's why we don't chase higher yielding securities. Even if you go back and say, oh, this company's paid their bonds every year for how many years? You could say that about a lot of companies that ultimately failed in a short period of time. And we just don't want to risk it. So because of that, we typically are going to stick to U.S. Treasuries, brokered CDs that you can buy through a brokerage platform like Charles Schwab or Fidelity, or you can go buy them from a local credit union. And then we'll also buy government agency bonds. We don't buy every agency, but the ones that have a good track record. And so in degree of risk, each step you take on that ladder is slightly more risky, right? So U.S. Treasuries are the least risky of those three. CDs up to $250,000 per issuer, so per bank issuing the CD, is insured by the FDIC. That's kind of the next level of risk. And then agency bonds are the most risky of the three, but still relatively not risky compared to corporate bonds. And so we really stick to those three categories. With the yields being in the environment they have been, sometimes we see US Treasuries are actually yielding more than the CDs are. And then it's a no-brainer, right? You're having a less risky asset that's paying you more. Those of you in high tax states, sometimes we look at buying municipal bonds. I use California as an example because it's on everybody's mind with the fires. Municipal bonds do carry risk. You really need a professional to screen the quality of every single municipal bond you buy. You won't see us buying municipal bonds from states like Illinois that have, poor credit ratings. That's where I was raised, by the way, so not picking on you if you're in Illinois. But we have a team that screens for those when we do buy them. But know that U.S. Treasuries are not taxable at the state level. So like if you're in California and you're a high income earner and you're deciding between a treasury and a CD that's maybe yielding a little bit more, it's actually more tax efficient to buy the treasury in those non-retirement accounts. So those are some of the factors that we look at. I know we want to leave time for questions, so I'll wrap it up there as far as fixed income. But please feel free to ask questions. We could probably do a full presentation just on this slide.
Yeah, bonds are more complicated than stocks. It surprises a lot of people, but there's simply a lot more to it. Last thing we want to cover, and this will be brief, and then we'll open it up to Q&A. And again, I've seen so many questions come in, which we really appreciate, is just this concept of setting up seamless retirement paychecks. So cash management in retirement takes a lot more time than people might think. Sometimes we have clients with 8 different accounts, and we're coordinating the withdrawals from this IRA. Sometimes it's a his and hers IRA, a Roth IRA, a trust account, or a joint brokerage account. And so we like this concept of making sure we've outlined where the cash is going to come from first, based on tax efficiency. So what accounts should deliver cash flow in which years to even out the tax rate, what we call the effective tax rate, over the lifetime of the client? Like, how do we make a plan that's likely going to save you the most taxes over the course of your retirement, not just this year? Sometimes the thing that saves you the most this year will actually cost you more in the long run. So it has to be viewed a little differently. So that's number one. We lay out where the checks are going to come from. We look at tax withholding. Do we need to set up withholding directly from the IRA or 401k distributions? You can set tax withholding. They send it right to the IRS for you, just like your employer did if you were working, kind of like it comes right out of your paycheck. It could come right out of your retirement paycheck. Or sometimes you need to make quarterly payments. If you're not taking IRA distributions yet, you may have to make a quarterly payment, or some people don't like quarterly, so we could chart it all out and you make one payment, April 15th or June 15th, and that covers your tax liability for the year. So that has to be accounted for. And then we really like direct deposit. So in some cases, all the cash is coming out of one account, direct deposit linked to the client's working checking account. In other cases, we're consolidating cash from 5 or 6 accounts and then delivering it in one seamless retirement paycheck. Some clients will set up monthly paychecks, the 1st, the 15th. We have a few that do bi-monthly. So it's truly replicating what they experienced while they were working. They might say, well, I want $4,000 direct deposit on the 1st of the month and the 15th of the month. And so we work with you to set up that paycheck. We also have clients that take monthly or bi-monthly direct deposits, and then they might have a lump sum set up to cover property taxes that occur just once a year, or it might cover long-term care insurance premiums. So we set up that deposit to hit their account, 2 weeks before the premiums normally due. So there's all kinds of different structures that we think are better than just kind of willy-nilly saying, well, I'll take out money when I need it. CJ, any pros, cons to this structure that you see?
I think the pro for retirees is that it feels like it did when you were still working. It's easier to budget. It's a lot easier to manage. If you're using an income ladder approach, you've got a lot of income coming in the portfolio. It's not as simple as just rebalancing quarterly, like maybe you've been doing within your accumulation phase. And as a result, you have to make decisions on cash flows we do it for our clients every single day, because you have interest paying out from bonds, you've got maturities, cash flow needs change. So, that's one of the downsides to doing it that way, is it is a lot of work. But for the clients that have set it up, I think it creates a more successful lifestyle than, like Dana said, wondering how you're going to pay your next, credit card bill because you didn't structure it to hit your checking account. So really our goal is to allow people to live their lives in retirement without the stress of money. That's our primary mission. And this is the best way to do that from a structure if you do the work up front to really make it happen.
Absolutely. And we get, we call them love letters, but clients often send us comments and, will tell us how we've helped ease this transition into retirement and really taken that stress off them. We ask our clients to send us pictures of them out on vacation. That's one of my favorites is, we want to see them out there enjoying retirement. And we're lucky that we really, are able to love what we do when we can help people go out and enjoy this time in their life. With that being said, we're going to open it up to questions and answers. Nancy is hopefully going to be able to come back on. She's fighting off a cold. And so, I see her. So if her voice holds out, she's going to help us sort through which questions we've answered and which ones still need to be answered. And then she'll read them off and CJ and I'll figure out who's best to answer them.
Thank you in advance, Nancy. I'm reading the question box and there's my head is
spinning.
There
are lots and lots.
We need you.
Lots and lots of questions. And what I'll try to do is where there's some overlap or it's answered, I won't necessarily, specifically hit every single question. Hopefully some of it's covered by another question. As a starting point, what's better, withdraw from an IRA to reduce RMDs or withdraw from an after-tax investment account because there's carryover loss from 2022?
So it depends. Our famous answer, we don't know without projecting out, as I mentioned, we have to have a model that projects out the outcomes over your entire retirement lifetime. So there are many, many cases where it does make sense to withdraw from IRAs earlier before your RMDs begin. But we don't know specifically if that is the right case for you without doing that projection.
Based on what you do for clients in coordinating various aspects and decumulation strategies, it seems very customized and thus time intensive. Given such a personalized approach, I assume so many across so many clients. How easy or challenging is it to do this?
CJ, you want to take that one?
Well, sure. I mean, I can tell you, I love the content we cover. I love what we do every day. If it was easy, I probably wouldn't want to do it and I wouldn't like it so much. We like it because it is challenging, but it's also important. And so, the short answer is the people that do it themselves have to really like to do it too. And we have people that have engaged us like that for a plan, and then maybe they are do-it-yourselfers and they've always been do-it-yourselfers. Occasionally, we'll have people that we don't think should be doing it themselves, and we're honest about that. But occasionally we find people that love it as much as we do, and they are willing to do the work. Where you run into trouble is when you don't want to hire a professional, and you also maybe don't want to do all the legwork that you've mentioned. Well, then you start making mistakes and subjecting yourself to, those negative consequences of that.
Yeah, and I'll add to that because I've been in this industry since 1995. And what I've found at many other firms, is this concept of what I coined coupon clippers. And I know Nancy, who's also worked for many other firms, she and I have talked about this of, the goal is to gather assets and put you in an automatic portfolio, and then they're off marketing for the next client. But our structure is different. We put a lot of content out there, so none of our financial advisors are out there doing marketing. That's not their primary role. We want them understanding all of the technical knowledge that goes into retirement planning and actually in this day in, day out, managing cash flow, knowing the tax rules, making these portfolio decisions. And so it is more challenging. Michael Kitces has a whole article on this somewhere out there talking about how when you are working exclusively with retirees, it is more work, it is more hours. But as CJ said, we love it. It's just truly like, to me, it's one of the most rewarding things we could do. And we get love letters from clients, and that's what makes us love it. But I really think our structure is a lot different. We are not coupon clippers. And if ever I felt like anyone here was going that direction and trying to do the least amount possible, then they're not going to be here very long, because that's just not a business model I support.
I will share one thing really quickly, briefly. I learned that most people don't have the same passions that I do for retirement income planning when I was at a party with a bunch of people in their mid-20s and early 30s, and I started talking about Medicare, and everybody walked away from me. So it's not for everybody. We get it.
Yeah. That's all I talk about when I go to parties. So when people come for one-time portfolio review and advice how to manage on your own, does one FA, financial advisor, create the whole plan, or does some other financial advisor review the plan before presenting it back to the client? So maybe this is more how kind of structurally, how do we work from juicing to juicing plus? I think that's the underlying question.
It really depends on the situation. So we work in teams, and generally it's a team of 3. There's a client service associate that handles a lot of the paperwork and scheduling and things like that. And then there's a executive financial planner, CJ and I and Nancy are all in that role. And then we are usually supported by a secondary financial planner. And so that secondary planner will often do a lot of the data entry or research. And so it's the executive financial planner reviewing the plan and presenting it to the client. So in that case, there are 2 people looking at it. But we also have a Slack channel called our planning channel, where we are constantly, like, it's a constant feed. Hey, is anyone da 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 da? And so we share links to plans with each other. And so there's often times where one of us, will pop into a client's plan at request and say, okay, here's what I would do, or here's how you handle that, because I've encountered that before.
And I think too, because the question starts off with when people come in for a one-time portfolio review and advice on how to manage on your own, that's really not what we are. That's not what we're about. We do a plan, right? Not a portfolio review.
No, that's a good point, Nancy. Yeah, we will do plans for clients, but it's a series of meetings. It's a very robust process. Primarily, we're structured to form long-term partnerships with people. Most of our clients come into our investment management service, so they go through a planning process and then move into that ongoing service of having us take over the management of the portfolio. So it's not too often, and we don't just do portfolio reviews. We find we can't review the portfolio without a full plan, because first we're aligning cash flows based on taxes. And there's no way to do that without having all the data and knowing, when Social Security is going to start, if you have deferred compensation plans, if you have restricted stock units that you're going to be exercising. There's so much that goes into it. We have to know all of that to then see, well, how would the portfolio align around all of those other things? So we can't simply do a portfolio review.
Right. I think for some advisors, it's kind of an entryway to maybe begin a relationship, but we wouldn't be able to provide advice, because without the plan, we don't know what to do. What about using an income annuity to provide retirement income? Is this a good idea?
Like everything, it depends. I wish we could give more concrete answers, but there's definitely cases where we've put lifetime income annuities in place, usually not for all of the cash flow that's needed. So it's a tool that goes in your retirement toolbox like anything else. There's the difference between longevity, and so an annuity is great at providing income for longevity purposes. So is deferring the start date of your Social Security in most cases. And then there's shorter coverage, like bond ladders provide, guaranteed cash flow, but on a shorter time basis. We look at something called a coverage ratio. So we talked about that time where your confidence is high, but your financial literacy is not as strong. That usually is around your mid 70s. So in a client's plan, we'll look out to their mid 70s and say, okay, they've started Social Security, pensions, any other kind of guaranteed income. How much of their outgoing expenses are covered by guaranteed income? That's what we call the coverage ratio. And but depending on that ratio, generally if it's under 50%, then there's some other metrics that we might look at. Then we'll bring up the concept of an income annuity. The other metrics are something we call fundedness. And so, I could have a very well-off client, net worth of 10 or 15 million, and they may have a very low coverage ratio because Social Security is going to be a relatively small portion of their income compared to what they're withdrawing from their portfolio. But their worth may be enough that when we look at an income annuity, they go, okay, they don't really need it because they're so overfunded. On the flip side, we've had very well-funded clients who are very risk adverse and love that concept of the income annuity. They want to guarantee the outcome. So long answer to say it depends. There's some, metrics we look at in a very analytical way. And then like so much, like the drawing you see, it's your money, your values, your plan. So we have the metrics, but there's so much behavioral side that factors into that decision that can make it the right decision for one person because it brings that peace of mind, and it could be the wrong decision for someone else.
Yeah. I love this next question, and I'll just throw out that I have probably a handful, good size handful, of clients I've done a juicing plan with, and the intent is to make the introduction to get to know us so that when the spouse who is not the active investor, comfortable, confident, has a place to go when his or her spouse dies. So the question is, can you address having you as a backup for taking over management when a spouse dies and address the letter to a loved one on where to go? I saw Dana sent out Fritz's post.
Yeah, so that concept of having someone for your spouse to go to, I think is great. For those listening who don't know who Fritz is, Fritz Gilbert has a blog called The Retirement Manifesto. I love his work. He, journaled extensively throughout his own retirement journey and shares the updates to his plan, and it's really cool. So, when you're managing your own, who will take over when you're gone? And so you can name someone and have a love letter to your spouse. It doesn't mean they're going to follow your instructions. So I can tell you about two particular cases. One, someone who has passed away. He was a very prolific writer and blogger in the retirement industry also. But many, many years ago, he had written to me that, he had instructed his wife to reach out, but when he passed, we didn't ever hear from them, and I didn't know how to get in touch with her, and it wouldn't have been appropriate for me to either. So while I know at one point that was his intention, it didn't materialize. I had another case that I can't remember which of our planners and I worked on, but the wife was the primary financial decision maker, and she was diagnosed with a chronic illness. She had less than a year to live. And so she hired us and had us do a plan, and she instructed her husband the same. Like, when I pass, you are to turn all the assets over. Well, when she passed, he decided that wasn't what he wanted to do and decided to do it himself. And he might be just fine. It wasn't his nature, I will tell you that. So we don't know what happened. And so I think it's a great idea to make sure your spouse is educated now. And why is this important? But like we saw, the likely time you're going to pass when, cognitive decline or the ability to make sound financial decisions isn't there, but the confidence is there, you just don't know what your spouse is going to do. But the more steps you can take to, if you're the primary person and they have no interest in it, the more steps you can take to lay that out, the better. We've had many, many people hire us simply for that reason. Like, They probably could do it themselves. We're adding a little bit of value to that. We do feel like we are, tweaking. They could have done a fair enough job. There's things we can do a little bit better, but would it materially impact their outcome, what we do? No, but there's small little things. But their primary reason was making sure that spouse would have a very seamless transition in that situation.
Thoughts on QLACs? Do you have any?
CJ, you haven't? I have some, but I'll try to spread the love in question answering. You have any thoughts, CJ, or you want me to share mine?
Yeah, well, I'll just start by saying what a QLAC is in general, right? Is you basically carve out some of your IRA assets and you put it in an annuity product. It's called a qualified longevity annuity contract. And basically at a certain age, you start that. And I believe the benefit on paper is that you basically de-risk that portion of your portfolio for lifetime income later. And it also, I think, exempts that portion from required minimum distributions. I don't personally pursue it that often, but I know there are cases where it makes sense. Dana, I'm curious where you've seen it work in action.
Well, the reality is I've never seen it work in action. So,
Yeah.
but it doesn't mean I think it wouldn't. Anyone who's listened to me for a long time knows I believe every financial vehicle is a tool, and that tool is going to have a good use case. Some of them are tools that you just don't need as often. Reverse mortgages, we have a few clients that have those because it was the right tool for the job, but we don't have a lot of clients that use them. I think of the QLAC as, you're basically, as CJ said, setting aside a chunk of money. You're not going to have required distributions, and it's going to guarantee this income later. In many cases, it's going to create this tax event later in life when your other taxable income can also be higher. If you're married, there could be a surviving spouse at that point that's now filing at single tax rates. And when we've looked at all of that, I'm not a fan. I'm a fan of things that have a little bit more optionality. So if you followed Wade Pfau and his retirement income questionnaire that he uses, he'll, categorize people into quadrants. And so if you're commitment and safety oriented, then perhaps that tool is right. So back to your values, your money, your plan, right? You want to know everything's dialed in. Well, you could use a QLAC, you could use a fixed annuity to cover the years until then, or a bond ladder, and have this beautiful floor of income guaranteed for life. And for some people, that is absolutely the right decision, but can't change your mind. People get sick, their kids get sick, the spouse, things happen, they want to move. And so it just doesn't leave as much optionality, which is why I tend to not go to that as a first choice.
I have several funds in my portfolio, from small cap, large cap, mid cap REITs. I added bond funds several years ago, and those funds are the only funds I have now that are negative. 78 and my allocation is 80-20. I'm currently not taking distributions from these funds since I have enough from other sources. So that's the question/statement. But I think this is also a good place to maybe wrap in, what is it that we use in the income ladder? Why? What don't we use? Why?
Was there a question in there, or it was just a statement?
No, it was more of a statement, but I think it speaks to other questions that have come up around the composition of the income ladder. So this would maybe be he's pointing out that the bond funds are the ones that are negative, and there's a reason we don't use bond funds, for example. So, like, what do we use in our income ladder, and why, and what don't we use and why?
Yeah, CJ?
Yeah, well, I think I mentioned this a little bit in the presentation, but we do individual securities that you can hold till maturity. Sometimes that's not an option. Like if you have most of your assets in a 401k plan, you may be relegated to using bond funds for that portion of the portfolio. But even then, you want to understand the duration, meaning that if you have like an ag fund, like a bond that just covers the full bond index, the entire bond market, you're going to have those longer maturity instruments. If you do use bond funds for part of your income, I would recommend taking a look at shorter duration bond funds if that's the option you have to do. Or I think I saw somebody mention bullet shares ETFs as a potential other option. The other thing I'll mention too is when you see losses in your financial account, it's not always transparent. And what I mean by that is you have to look at how you're investing those dividends and those payouts from those funds. So if you're just looking at your broker and seeing a capital loss, it doesn't necessarily mean that the fund is actually negative. Bond funds are going to have a higher income payout, meaning most of their returns are going to come from those quarterly dividends. Whereas stocks, a huge portion of the return is typically going to come not just from dividends, but also from capital appreciation. And so I'm not saying in this case that the bond funds haven't lost money. They might have through 2022. But sometimes you see those bond funds as negative. But when you actually look at the interest that's been paid out, you actually have a decent return. And so we use a performance reporting software, not Charles Schwab's our custodian. We don't necessarily rely on the cost basis numbers to assess that. So I would say just in general, be really careful about measuring success no matter what you buy. So hopefully that insight is useful.
Dana, this is specifically to Dana. So Dana, you mentioned double rung bond ladders. Does that mean that instead of 10 bonds maturing once per year, you buy 2 bonds per year for 5 years, so the duration is shorter?
So interesting. Did I mention that on this webinar? This must be someone who knows me. I can't see the name because I'm like, I don't think I said that during this webinar, but yes, I do talk about that sometimes. Particularly, there's 2 times where we've done this. One, when shorter term yields are higher than longer term yields, where we might say, well, let's double up on the bond ladder. It also provides more optionality rather than locking those cash flows in for a longer time frame. The bonds mature. You won't need all the cash flow. They can be reinvested. There's some risk there. When the bonds mature, interest rates could be lower. We might not be able to lock in as high of a yield as we could have if we had built out a longer bond ladder. But that's one time where we really had interest rates that were higher. That's not the case today, but a few years ago, interest rates were much higher on the shorter end of the curve. And so there was some times where we would double up the ladder. Another case is as our clients get older. So we talk a lot about this transition into retirement. That's what my wind down paper is about. But I believe our oldest client is 88 or 89. And so I don't really want a 10-year bond ladder because they're less liquid. Their heirs might inherit those bonds and might not need the individual bonds, and we would have to sell them. And so as clients get older, we will tend to shorten the ladder, but make it a taller or thicker ladder because long-term care expenses should come in. We might need extra money to cover these costs. There's all kinds of reasons where we might shorten up the ladder in that case where someone's now in their early 80s.
What do you think? I'm sorry. What do you do when guaranteed income like annuities and Social Security cover most of your expenses by deferring Social Security until 70? How should one approach decumulation between retirement at, say, 67 going forward?
So it's funny, when you just read the first half of that question, I was like, you party? No, yeah. I mean, so if all your cash flow is covered by guaranteed income, like, woohoo! But I get that's not quite what you were asking. You were asking, so if you delay Social Security till 70, right? And then at that point, guaranteed income is going to cover all your expenses along with your RMDs. How do you cover your cash flow in before 70? I think that was the real question. Yeah. Yep. And so usually we're doing that through IRA withdrawals, or, if they have a joint brokerage account, it could be CDs that are maturing, or if they have a appreciated stock or mutual fund asset, we have a plan to liquidate that. But it's all planned out based on how much capital gains taxes, depending on the tax implications, what IRMA, that's an income related monthly premium amount that you pay for Medicare Part B if your income is too high. So all of that gets planned out to come up with, okay, what's the best way to cover these cash flows pre-age 70? What's the most tax efficient way to do it? Now that ties in with something I didn't cover, which is the 4% rule that we all hear about. We've just rewritten our 4% rule free report. It's not out yet, but we've brought it. It was originally written probably 7 years ago. So I've rewritten it. Modern version is out. But the general concept is, you hear about this. Okay, if you have $1 million, you can take about 40,000 a year out and safely increase that with inflation, expect to have it last for life. But sometimes that makes people make bad decisions, like not delaying Social Security. Because if they delay Social Security, let's say you were going to get 40,000 from Social Security, but you delay it, now you have to take that 40,000 out of your portfolio along with everything else, and you go, oh no, that's more than 4%. I shouldn't do that. It's not the case. It's why we use one of the metrics we use called fundedness, which think of it as like a 4% rule for your lifetime. It looks at cash flows over your lifetime and says, yeah, you could take this extra money out for 3 or 4 years and cover that gap until Social Security, no problem. And it actually makes your plan look better, not worse. And so same with car purchases or major trips or remodels or things that people often do early in retirement in what we call the go-go years. Most of the time, those expenses are completely feasible, even if they mean exceeding the 4% rule. And so we plan all of that out. It's a long answer to your question, but how do you cover the gap between 67 and 70? You plan all of that
out. Since interest rate drops are likely, is that valuation already reflected in bonds? Are bonds now a no-brainer to buy?
That's a great question. So in general, if you're saying, okay, interest rates are likely and that's a perception, part of that is priced in. And you see that in the yield curve, which we didn't get a chance to talk about bond pricing and returns much today. But in general, those expectations, though, change very frequently. People like to think about the yield curve as static, but it's very dynamic. So is inflation. It's not linear. So I'm always careful trying to make a portfolio decision based on an assumption or a perception of what's going to happen. Just like how this time of year, there's tons of articles every single year that go back to January of last year. And they say, what kind of equity analysts and the predictors of the market were right? And the answer is always hardly anybody. The same thing is true of the bond market. We saw yields, or even like the expectations beginning of 2024 was there was going to be 6 or 7 rate cuts, and there was 2. And now there might not be any for 2025. So I wouldn't try to play the yield curve game. Just remember the bond portion of your portfolio is designed to deliver income when you're in retirement. That's how we use bonds. We're not using it to chase returns or trying to time the market. So whether or not it's a no-brainer really depends on your income need. It could be, in some ways a no-brainer depending on your plan to sell some equities and buy some income, and rates are certainly favorable. To do that. We've been doing that with clients, but I wouldn't go rush into bond funds just because you think rates are going to drop. Truthfully, they might not. And where you see volatility is when expectations change, not when what's supposed to happen happens. And that's where the risk comes in. And that's what we saw in 2022.
I think what comes to my mind is, I think there was a famous hedge fund called Long-Term Capital Management that went bankrupt because they were seeing something in the interest rate market that was also certain, and they were wrong and bankrupted, and a lot of very wealthy people lost a lot of money because it was an interest rate move that seemed absolutely certain. These were really, really smart people. So it's there's always a risk that what we think seems so certain doesn't actually happen.
And if it makes you feel better, nobody at the Federal Reserve knows what's going to happen to interest rates. So it's not even just us. There's really nobody out there that can predict it.
So I'm going to fold a couple of questions into this. One is, what are your fees? And the other is, can you talk about how I would measure the value of the Juicing Plus plan as part of my retirement?
It's a great question, because fees are only relevant in the absence of value. And so I don't know who said that, but it's a famous line that's out there. How our pricing works. So when we initially do a juicing plan, it's either 6,900 or 8,900. And I know that sounds weird to say, well, which is it? Well, you have an introductory conversation with one of our planners, and there are some clients that have very complex plans. They have a lot of real estate holdings, maybe a lot of executive stock compensation, things that we know are going to require a lot of extra time. And so that we call those complex plans, and they're priced at that higher level. The majority of the people we talk to have a situation that is not, so there can still be complexities, but there's basic complexities that we're used to dealing with. And so those plans are priced at 6,900. Once you go through that planning process, you have the option to move into our Juicing Plus. Now, we do it very differently than most firms. Most firms you talk to and they want you to move all your assets over, and we actually don't think that makes sense. Through the planning process, you get a very valuable plan, a lot of education. People tell us they've learned more about their finances and retirement. They are better informed than they've ever been in their entire life. Like, we get love letters. Some of them post our Google reviews. You can go read them just from that planning process itself. When you go through that, you'll see the level of detail and work that we do. And if you're looking for someone to delegate to, you'll know by the end of that plan. When it comes to the Juicing Plus, the main value is we're doing all of this for you. So you don't have to think about it. Clients might email us. I mean, we had one email us just the other day. Well, what should I change my catch-up contributions to? Now, I know this particular client, and probably they're savvy enough that they could have figured it out, but they don't have to. Like, they just email us and ask, and we're going to get right back to them and say, here's what you need to do. So it can be all kinds of things that people they don't want to think about it. They want to be able to delegate it. My favorite story I tell is a client that had Apple stock when they first came on. We were able to exit them out of a little of it at 0% capital gains, which was super cool. And then they, decided to work with us on a full-time basis. And maybe it was about a year or two after they started, they said, "This is so great. We don't watch financial TV anymore." And so they were able to turn off CNBC and, all of the ticker symbols running and the constant, should I be doing this or that? And that was the real value that we brought. Sometimes it's different. It's spouses who disagree on what they should do and how they should handle things. And so we're able to come in and say, this is a cohesive plan. All your assets need to work together. People who aren't sure if they should sell certain properties or when they should, exercise certain stock options. It's just all kinds of decisions that we can come in and quantify. CJ or Nancy, you hear, directly from clients more often than I do now.
Yeah.
What do you guys want to add to that?
Well, I loved your answer, Dana, because it focuses on the qualitative. And so oftentimes when we're having these discussions, with prospective clients, I do break down the quantitative versus the qualitative, and the qualitative is always far more compelling. The reality about retirement planning is that it is a lifelong pursuit, not just because your circumstances will change, but also because the rules change. There are aspects of this business that are vastly different than they were even 5 years ago. This is actually a really timely time to be thinking about this, because for many do-it-yourself retirement planners, we're expecting a really big tax bill to occur by the end of this year, which means for your Roth conversion strategies, which means for your withdrawal strategies, your actual cash flow needs, those are all going to be impacted. And for many retirees, it's going to feel like hitting the reset button and starting over from scratch. What I love about our process is that it is iterative. Every plan we put together is designed, yes, to make recommendations today, but it has a flexible framework so that we know we can adjust those recommendations down the line as the client's needs change or as the broader circumstances change. The last piece that I'll mention is that back to the lifelong pursuit, you're going to go through phases of your retirement. When you're 50, it's very hard to conceptualize what your needs might be at 70. Just like when you were 30, it was very hard to conceptualize what your needs would be at 50. And so because of that, having somebody that understands who you are and what your goals are and building that long-term relationship, it'll help you make those good decisions as you face territory you've never really considered before. And those blind spots, those areas where you don't know what you don't know, that's where you're most likely to slip up, as a do-it-yourself retirement investor.
Oh, all of the above. I would agree. I don't want to say too much, as I'll start coughing. One of the as a follow up to that, there are a number of people who are asking specifically about what is the cost of the plan, and how much is juicing on an annual basis? What are your fees? So I don't know if you want to kind of go through what that looks like.
In general, we would encourage you to set up an introductory meeting. And so, most people who are just going to do a plan don't need necessarily to update that plan each and every year. The pricing could change because the market changes, the cost of staff changes. There's just all kinds of things. And so, we can tell you what the price for a plan is today, but we have raised prices in the past. And so, you would want to set up an introductory meeting, really discuss your needs. That's where you can decide, like, okay, do I need ongoing advice, or where are you at in this journey, and get into a lot of those details.
Yep. Given the current administration is working to dismantle government institutions and norms of all types, are you advising clients differently? And if so, how? And I think it's whether it's a current administration, whether it's an inflation spike, whether it's something happening somewhere in the world, the answer is pretty similar, right?
Yeah. I'm going to have CJ tackle this one because, he actually is a politics aficionado, I'll say.
I wouldn't say politics. I'd say policy. I like policy a lot more than politics. But I will say in general, clients hire us back to like our value because of our objectivity. And when we talk about biases that lead people to make bad decisions, it's not just in the investment market. A lot of the time it is what you're seeing in the news, and it's okay that you have an emotional impact. We all do when we see these things that we care about. It doesn't mean that that's going to lead you to make an objective decision. We've seen many administrations, right? And depending on who you talk to, we have clients across the political spectrum. Some are celebrating, some are terrified. We know that's always going to be the case no matter who's in office. We also know what's being talked about happening hasn't actually happened yet in general, and that will always be the case. So we believe in the capital markets. We ultimately believe in the broader institutions outside of government, that drive people's livelihoods. And so as long as that's the case, we're going to continue managing the plan with the same rules-based approach and not panicking. And sometimes not reacting is better than trying to time and make the right decision. We had a lot of clients that wanted to go in cash in 2016 for this very same reason. And looking back, it would have been a bad decision, for all of those clients. So, just some food for thought there.
Can your fees come out of the taxable IRA? So this is general, not just us, but I would think any advisor. Can fees come out of the taxable IRA account? And then also maybe talk about the Roth account and how we like to handle Roth accounts when possible.
Yeah, so legally, the IRA can cover its own fees proportionately, but it can't pay fees for other accounts because that would be, taking extra money out of the IRA. It's just not, and it would have to be considered a taxable distribution. But when fees come right out of the IRA account, that's not a taxable distribution. So you're able to use pre-tax dollars to cover the fees. But you can't use those pre-tax dollars to cover the fees on other account types. That's just how the rules work. For a Roth IRA, however, because it's all, tax-free, we don't want to take any fees out of the Roth IRA. We can actually take those out of a regular joint brokerage or taxable account. And so we do to the extent possible. We want all the funds in the Roth IRA to continue to grow tax-free as much as possible. And so there's certain rules we have to follow and how we do that. But IRA pre-tax can only cover its own proportional share. A joint brokerage account can cover the fees for the Roth. That's basically the way to think of it. And the joint brokerage account could cover the fees for the IRA too, but in most cases that doesn't make sense. We want those pre-tax dollars to cover its own proportional share.
You like the bucket strategy, whereas other FAs, financial advisors, prefer 60-40 or 70-30 in asset allocation. Both strategies use the same thinking of using the bucket or the side of the asset allocation that is doing better. So how exactly do these two strategies differ, and why do you view the bucket strategy as better?
So the strategies differ. One is an automatic rebalancing process, and oftentimes it requires you to, sell proportionately. So as you said, whichever assets are doing better at the time you're drawing out cash flow, you're selling those. And if you're also rebalancing at the same time, you may be selling some of those and buying the assets that aren't doing as well. And so it's a much more traditional approach. There have been a lot of studies done. If you want to see, Wade Pfau has a series on advisor perspectives called Time Segmentation. I can't remember the exact full name of the series, but he does a 3-part series on this and actually looks at what are called personalized ladders, which is what we do. And in his study, the probabilities, again, we play the odds, showed that that was the best performing strategy. However, the reason it turned out, at least over the study he did, to be better had to do with it actually maintained a slightly higher equity allocation. I refer and I reference these studies in my paper. So if you go look it up, Nancy posted the link in the chat, or you download it, you'll find the references to Wade's paper and you can go read all of the details on that. But we like it not for any of the technical reasons, for behavioral reasons. So back to what we started off, like we are emotional creatures, and the behavioral aspect of having that bond ladder, we have found allows people to stick with their portfolio, relax as they enter retirement. Like we've had clients retire into bear markets around COVID and email us going, oh my God, thank you so much. I understand how the bond ladder works. I know I don't have to worry about this. And so it's that behavioral aspect that we think really makes a difference.
What things can one do to maintain or increase financial literacy?
Attending webinars like this, you're already on the right track. Reading blogs. Fritz Gilbert can be a great one to start with. I know we all have our favorites. I love The Psychology of Money, the book that I mentioned by Morgan Housel. Nancy, CJ, do you have some of your favorites?
Oh, I think for just general kinds of things, Investopedia is a great source for questions. You want to be thoughtful about the source. There's a lot of stuff out there. Some of it's good. A lot of it's good. Some of it's not necessarily really accurate, but I like Investopedia.
I've still seen some questionable stuff come out of the AI ChatGPT, so sometimes it gets the rules up. We've posted some stuff in there before just to see, and I wouldn't say I'm at the point where I would be confident in what's coming out of that yet.
Yeah, I would add financial literacy. Some of it depends on the goal and what area you're trying to kind of up your game in. I remember when I started at Sensible Money, I did not grow up in a financial literate household, and I'd never seen a tax return. I didn't really know anything about Social Security, like most 22-year-olds probably didn't. So it was all like drinking out of a fire hose. And I remember going, and I got good grades in finance school. Like I did well, but even I was like, I don't know how I'm going to learn all this stuff. And when you really start just exposing yourself to the content, even if I used to read articles or watch some of the webinars or papers that Dana's mentioned that she would recommend to me, and I wouldn't understand hardly any of it, but just reading it started to, I would internalize some of the content, and then over time it starts to make sense. This is a professional field. It's like I just had lunch with a friend of mine. He's an attorney, and I don't ever seem to want to ask an attorney, how do I become more legally literate? Right? Because I understand the work that goes into it and all the expertise. Finance is no different. So, there are levels to this. And I would say, just like everybody's mentioned, expose yourself on a regular basis, read things that are interesting to you, and you will just get better over time.
Yeah, and I think to the extent that the information you're taking in around personal finance is specific to your own situation, it's kind of easier to start with what directly affects you and move out from there versus trying to learn all about personal finance when there may be a lot of things that just will never impact you. It can make it feel
Nancy, there's
overwhelming.
three grouped questions I want to just address really quick.
Mm-hmm.
One of them is, why don't you use tips? What length of bonds, what length of ladder do you like? And what about using MYGAs, which is basically a form of a annuity, a fixed annuity. And so I just want to address those, because they kind of all go together.
Yeah.
Why don't we use tips? Well, there's research out. They're actually not a great inflation hedge. That's a simple answer. So when inflation came around very suddenly, tips were not the things you wanted to own. So we find there's better ways to hedge the portfolio against inflation, and it's not with the fixed income side of the portfolio. That's a very simple answer. What length of bonds? Well, that's what my paper is about. Everyone wants to know, how long should my bond ladder be? Well, you let the market dictate that. You use this process, and as we saw, one person got to retirement with a 10-year ladder and one person got there with a 5-year ladder. Both are going to be okay. But you let the market and the process dictate how long that ladder is if you start planning ahead of time. That would be my simple answer. And what about using MYGAs or annuities? It gets challenging because most people have lots of different account types. If all your money is in one account, great. Well, let's say it's all a taxable brokerage account. Well, the MYGA, the interest is tax deferred, and now you cash it in and you have this extra taxable event because all the interest is taxable that year. Is that going to make sense with the rest of your plan? Well, what if it's in an IRA? Well, now you have to have all of these different MYGAs maturing. We've had issues. CJ and I had a client with an annuity that, oh my God, the paperwork to get their money out of that IRA annuity every year. I see you know who I'm talking about. It was, sometimes they would delay 6 weeks, 8 weeks, lose the paperwork. It was kind of craziness. And so from an operational standpoint, we were like, oh my gosh, even if I could gain 0.5% over laddering MYGAs, is it worth it with all of these extra restrictions? And so there's just some operational challenges. If you're managing your own and you don't mind working through all of those operational challenges, there certainly can be some options there that could work.
Yeah, one thing I'll add on MYGAs, they became extremely popular in 2020 because rates were, especially on individual bonds, almost nothing. And people in 2021 were saying, well, I have all these equities now from this run up, post-pandemic. How do I diversify my portfolio when I don't want to buy bonds yielding nothing? And so they opted to buy these MYGAs. And usually there's going to be like a 4-year lockup at minimum. And then it'll automatically renew if you don't exit. But people that did that, well, if you bought a MYGA in 2021, it just unlocked like right now, this month. And what happened to interest rates in the meantime? They went up and up and up. Back to our process not having static rebalancing, when you're using an income ladder approach, it allows you the opportunity to be more flexible. You don't have to do it all at once. You don't have to say, I'm going to lock in 4 years of income all at once right now. You can do it iteratively over time. And that benefited people in a lower rate environment because as rates risen, we didn't have their full income ladder necessarily in place, and we could sell growth and extend as rates rose. And so, like Dana said, it's more flexible, but that flexibility can actually even lead to a better outcome, over time as things change.
People don't actually spend at a fixed rate. Some years they spend more for a big vacation, major home repair, medical event. Those things come up. How is this handled when taking income from a bond that didn't account for this extra spending?
Oh, with, lots of spreadsheets.
Yeah.
But no, it's honestly, it happens all the time, right? So the bond ladder is designed to provide a floor. Think of it as like a, If the market goes down suddenly, I don't want the bulk of your cash flow this year. I don't want to have to sell out of those assets. So I have this floor, but extra expenses come up. And in most years, we're able to have interest income from those bonds that we will accumulate in what we call kind of a slush fund, money market fund, which is right now yielding, I think, about 4.2%. So we can accumulate this kind of buffer from interest from the bonds. And other times, in years where stocks are doing fine, we're just selling some of them to accommodate those cash flow needs. We're dropping it into the plan to figure out, what account should it come out of? Should it come out of the IRA or should it come out of the brokerage account, tax-wise, capital gains? We have to factor all of that in. So if someone says, I need an extra $50,000, that's our job. Blah, blah, blah. Where should it come from? What are the tax implications? Do you need to make a tax payment? How does this impact your plan? Ultimately, that's the great thing is people just tell us, I need this, and we go do it. We calculate all of that out and we send them the cash. If they do that too often, then we have a different conversation. Wow, you're taking an extra $50,000 a year out. And if you continue, that will impact the long-term metrics of your plan. You could be in trouble. Luckily, we don't have to have those conversations too often. But in general, that's how we look at it.
Dana, would you also maybe touch on what it is you do with, or what we do, with the kind of the rolling 5-year, go-go spending where people maybe want to spend more earlier in their plan, but we kind of have to take it a bit at a time?
I love that. So first of all, when you think it's something called the 4% rule, one of the things I talk about in the paper or in the rewritten report is it's as if you use that as your rule of thumb, it's based on like the worst possible market conditions, which probably, hopefully aren't going to materialize, right? So I think of it as I don't want to plan my whole retirement as if I'm retiring into the Great Depression. At the same time, I want to know I have a plan so that if normal bear markets that I would expect come along, they don't derail me. So there's that balance, right? But I don't want to plan as if it is the worst case scenario right up front. And so when we then look at what most people's plans, okay, this looks reasonable. We're very conservative in our assumptions. You're in your go-go years. Maybe we could spend an extra $20,000. Well, if I put that extra $20,000 in for 5 years, the plan still meets all the metrics we want it to meet. Great, let's do it. But if I put that $20,000 a year of extra spending in for the life of your plan for the next 30 years, and I look at that today, we might go, ooh, that's now in what we call the danger zone. It doesn't meet the metrics we want it to meet. But in many of those cases, we're so conservative that reality is going to exceed those metrics. And so every year we go along and let's say it's 2025 and we go, okay, yeah, you can spend that extra 20,000 for the next 5 years. 2026, yep, you can still spend it for the next 5 years. 2027, yep, it still looks good. And so we're able to just keep rolling that go-go spending forward. But if a March 2020 came along or, a great recession like 2008, 2009 came along, we might say, the continuation of that spending, maybe you should reduce it to 10,000 this year, or, we might need to taper that off over the next few years. So it allows us to adjust as we go. But in most cases, it's probably going to be feasible. I don't want to say that. You never know. We do have clients that we have to kind of rein in. So I don't want to say that in a webinar, but in a lot of cases, it's feasible to continue that go-go spending.
Do you include in client plans future tax saving strategies, Roths, but also how to reduce taxes and tax brackets?
AJ?
Yeah, we absolutely do. So, we've talked about this upfront plan that we do as a standalone. And one of the ways that we approach the tax planning is we say nothing changes to your standard of living, right? That's how we measure tax efficiency, kind of apples to apples. So we have a whole meeting. Our second meeting's all about that. Roth conversions are a plan tool that we use very frequently, but it's not the only one. And so one way to, for instance, reduce tax rates in retirement is if you're charitably inclined. Qualified charitable distributions are a great strategy. We talk about locating your assets in a way that increases tax efficiency. There are a lot of different tactics that you can use to achieve those goals. But personally, I think if you're not thinking about the taxes, you're doing a disservice, to your retirement plan. When the research shows when you itemize your budget, not just living expenses, but gas and groceries and all these things, taxes and healthcare end up being the two largest itemized items for most clients to us. So the items that they need the most help with typically. And so I'm glad that you asked that question.
Yeah. I'm assuming this is for Dana. Has your view of Bitcoin changed?
Oh, I know who's asking that question. I don't know what I ever said or did to you. I really have no idea. So I'm going to give the whole history on this because, so Bitcoin or cryptocurrency in itself, the underlying technology is absolutely changing all kinds of things. It's super, super incredible, blockchain technology. And Bitcoin is a new investable asset class. So I did a video, I don't remember what year, 2019 maybe, might have been 2020. I really don't know. I did it with Bob Powell of Retirement Daily, and I'm talking about this. And my goal with that video was there was people out there mortgaging their houses to buy Bitcoin. I mean, it was insanity, cashing in their retirement accounts. And so in this video, I said, if you want to use this asset class, 1% of your portfolio, right? 1%, if you're really could make sense. Yes, it's a new investable asset class, which I hold to that theme still today, right? None of my thinking on that has changed. For some reason, this one person constantly asks me this as if they're needling me. I don't really understand why, because I wasn't saying our clients should go invest in Bitcoin, nor was I saying everybody should go invest in Bitcoin. The whole objective that I was trying to accomplish with that video and with the newsletter that I sent out was educating people, as we talk about quite a bit, right? You need to be educated. The media is going nuts about this, and being prudent. Yeah, if you want to go put 1% of your portfolio, that's reasonable, but don't go mortgage your house. Don't cash in your retirement account and go put it all in Bitcoin. That was the point I was trying to make. So that was my view at that time, and that remains my view today. So somehow, I don't know if I said or did something to this person that communicated something differently, but I don't really know. I'll never know, I guess, because they've never told me.
You can always ask. I thought the IRS requires quarterly estimated tax payments, but you said that I can pay the entire year's liability by April 15th and be done for that year?
Well, you can. And so, but you would also have to know what your tax liability is going to be. And so there's can be some challenges, right? And would you really want to? Well, now you can earn interest on your money, right? A few years ago, interest rates were 0%, prepay your taxes, didn't really matter. But today, let's say I'm going to have a big tax liability. I don't know what big is. For some people, that's $2,000, and for other people, it's $200,000, right? But I'll use $20,000. Let's say you're gonna pay $20,000 in taxes. Well, why would you pay that on April 15th if you didn't have to, right? You could earn interest on that money and spread it out quarterly. But some people just don't like the hassle, having to remember to make the quarterly payments. They don't care about the interest. So sure, you could pay the full $20,000 on April 15th. And essentially, you're just prepaying your taxes for part of the year. But the other thing you can do, if you're of the age where you can withdraw from retirement, and if your tax plan says that it would actually make sense to use some of those retirement funds, is you could say, well, I'm going to have all the $20,000 withheld from my IRA in December of the year. So I got to earn interest on it all year long. And when it's withheld directly from the IRA, it's as if it was applied equally over the year. The risk in paying it all April 15th is, let's say later in the year, you have a capital gain event. We've had this happen with clients. Suddenly they decide to sell a lot or a property, or we have to sell a stock or a fund. Well, in that case, our job is to recalculate the taxes and say, well, you paid $20,000 on April 15th, but now we have an extra $100,000 of capital gains. And so you're going to need to make an extra quarterly payment because that taxable event occurred in the third quarter of the year, and so on. And so anyway, that's a really long answer, but you can see how complicated it can get. And there are numerous ways to do it.
Can I share one small piece of advice on this? Because it's very commonly asked by our clients. The quarterly tax payment schedule is extremely confusing. It's not even quarterly, by the way. It's April, then June, and then September, and then January. They did that because in the 1960s, they had to pass a budget and they wanted to move the payment up a month. So they did. Fun fact. And so they just never changed it back. Underpayment penalties, there are safe harbors that are often quoted, right? 90% of this year's tax if you pay it in, 100% or 110% of last year's tax if you pay it in. You're safe harbored from underpayment penalty no matter what you're going to owe when you file. If you're using safe harbor, you're theoretically supposed to make those payments quarterly. Where our clients run into trouble is, let's say you wanted to pay at the last possible moment, which would be April 15th when you file the following year, and pay no underpayment penalty. Well, you could do it quarterly. But what if you don't know what your income is going to be? Because you're going to wait till the fall to do a Roth conversion or realize gains. Well, like Dana said, if you realize a Roth conversion in, the fourth quarter, you should make a payment in January for the tax on that. But when you go to file your return, it might say that you were late on the safe harbor method. There's a form that you can fill out. It's called the annualized income installment method for the IRS. I don't remember the form numbers. CPAs know it. They don't often file it automatically, but if you have lumpy income, meaning most of your income is being generated in the fourth quarter, and so you're not making quarterly payments until then, make sure you ask your CPA or consult with TurboTax or whoever you self-file to use that method because it will eliminate that underpayment penalty. So just a practical tip there.
And I'm going to jump in with something else. I see someone saying, we love your webinars. Thank you. When is your next one? On the bottom of our homepage, sensiblemoney.com, you'll always find our next webinar. And so they've already posted it for us. It's going to be Thursday, March 27th, how to make a retirement income plan. And I will be doing that one joint with Amy Shepard, another one of our firm partners.
Dana and CJ, how do you feel about continuing? Some of the remaining questions are really variations on questions that have been asked and answered. I don't know if you...
Well, I think we're past 2 hours, so probably we should wrap up. We love all the questions. I know sometimes we go through them and try to get you customized answers. You're also welcome to post them on the comments on YouTube. So if there's additional questions, I do try to go in, not as regularly as I'd like, but sometimes I see questions that we can answer in the comments on once it's posted to YouTube. But probably we should wrap up. CJ, you're good with that?
Yes, absolutely. And the one thing I'll say too is info@sensiblemoney.com is another email option if you have a very lingering question that you want to reach out to us about.
Absolutely. CJ, thank you. Nancy, thank you. All of you attendees who stay on for 2 hours, you all amaze me. As CJ said, we're in this every day, but the fact that you all come and join us and most of you, actually, when I see the stats, we get this report, so many of you stay on the whole time, absolutely blows my mind. So thank you. Hopefully we helped you learn something today.
Thanks, everybody.
Bye, everybody.